Hey guys, Jacqueline here with Zenith Home Loans. I just want to thank you for joining me for another TCA Tuesday, Total Cost Analysis Tuesday. I'm trying out something a little bit different here, so bear with me while I figure out technology today. What I wanted to kind of go over today is down payment assistance, specifically CHFA, Colorado Housing and Finance Authority. So yes, they do have a down payment assistance program, but they also have a non-down payment assistance option. And so the reason why that's important to know is because a lot of times their non-down payment assistance program makes more sense than going the traditional route. So just because you don't need down payment assistance doesn't mean that CHFA is not a good resource for you. CHFA is really built for people who maybe have a little bit lower credit scores, higher debt to income, are just wanting to make sure that we're getting them into the right property. Maybe they don't necessarily need the down payment assistance, but what's really nice about CHFA is their rates are fixed. So they put out their rate sheet once per day, usually around 9 or 10 o'clock in the morning, and it's a stagnant rate. So it's only going to fluctuate based on the loan program that you're choosing. It doesn't matter how much you're putting down, whether it's a condo or a townhouse or a single family home, as long as it's a primary residence, you meet the income qualifying and you meet their debt to income and their credit score qualifying, the loan program still works. So what I'm going to do is just share my screen for you guys, and we're going to flip you around here so that you can take a look here at what I'm going to show you. So I had this with a client recently who we were doing 15% down. So it's this regular program here. They had a 680 credit score. So it was a conventional loan. It didn't make sense for us to go CHFA, had lower credit scores than what I'd like to see on a conventional loan. But the reason why it made sense for us to kind of switch things is because if we went 15% down, traditional conventional transaction, the rate would be 6.5%. If we go CHFA, we're at 5.875. So we're already saving some money here. So now our payment went from $32.34 to $30.50. And so we've got a monthly payment savings of around $200 per month. We're also saving around $6,000 at closing. So the CHFA loan makes more sense. They still have to participate in the homebuyer education if they're a first-time homebuyer. But what's nice about this program is we were able to cut this rate in half almost and save them so much money per month. And the mortgage insurance was cheaper. They opted to go for a upfront premium on their particular loan structure, and it saved them about $3,000. So why this matters here is, one, we're able to get them into a better rate. This actually helps them qualify for the loan that they wouldn't have qualified for at 6.5%. And then their closing costs were less, obviously, as well. So overall, this particular scenario makes so much more sense and zero impact to the seller whatsoever. So absolutely makes sense. Everybody's happy. We've got a great rate, great monthly payment, saving $6,000 cash out of pocket. We can buy new furniture. Another scenario that makes sense to take a look at is 5% down conventional condo versus a CHFA condo. So condos carry with them a higher interest rate because they're a greater risk to the investor. The reason why they're a greater risk to the investor is because we're now reliant on your HOA not being in litigation, having correct reserves, budgeting correctly, not having any delinquent HOAs, not having too many people who are investors versus primary homeowners, things like that. We're also reliant on the value of your home based on what everyone else in the community is doing. So if you have a couple of bad eggs in there where we've got properties are dilapidated and maybe property values are coming down from that perspective, that's going to negatively impact you as the homeowner. So mortgage brokers will charge a higher interest rate, higher costs, higher mortgage insurance in order for us to finance those. CHFA doesn't do that. So we have the exact same scenario, 5% down conventional condo, 6.5% if we don't go CHFA. If we do go CHFA, again, we don't need down payment assistance here, 5.875. So we've got a better rate here. Monthly payment, $200 less. Cash to close, it's a little bit higher on the CHFA condo, but we're getting a much better rate. So then it comes down to, okay, does this make sense financially? What's my break even? Because there are additional fees on CHFA. But the bottom line here is just paying attention to the fact that we can take a look at utilizing CHFA even if you don't need down payment assistance. And if you're doing something as low as 5% down, it may make sense for us to just have that down payment assistance in there. It's a 0% loan. It does have to eventually be paid back once you go to sell the property or if you were to ever refinance it, but that might give you a little bit more of a cushion. We can bring this number down and now you can do some renovations to the property. If you're in a situation where we do need to look at appraisal gap coverage, you have an opportunity to do that. So we're able to pad the funds that you do have into your transaction. So that is just kind of one of the scenarios that you can explore when doing these different CHFA down payment assistance or non-down payment assistance programs. The other thing to keep in mind too is looking at your overall savings over 60 months. So we can take a look at those scenarios as well. But bottom line is, just because you have a larger down payment or just because it only makes sense to go to conventional doesn't necessarily mean that's the only way to do it. There's lots of different loan programs that exist within the different loan structures that we absolutely want to take a look at. And that's why it's so important to work with somebody who's looking out for your bottom line and looking for the best payment savings and figuring out, okay, what's maybe a better scenario. This transaction that I had that closed a couple of weeks ago, this came down to my borrower qualifying for a property that met their family needs for having the number of bedrooms and the amount of space that they needed, and qualifying for that monthly payment and that property, to not being able to qualify at all and having to settle for a much smaller property. So it absolutely makes sense to work with somebody who's going to kind of pay attention to those kinds of options for you and look for what makes the most sense for you, because not one loan does not fit all. So I hope this was helpful information today. If there's additional questions or specific scenarios you'd like to see, feel free to reach out to me. I am here. Have